Welcome. Today we're doing a deep dive into something pretty fascinating in the finance world. Bill Ackman's big ambition. He apparently wants to be the next Warren Buffett.
That's right. And we're digging into this space largely on a SinShots article from February 25th, 2025. Title says it all, really. Bill Ackman wants to be Warren Buffett.
So our mission here is to unpack that. What's Ackman actually planning? How does it stack up against what Buffett did?
And crucially, can his plan to remake Howard Hughes Holdings HHH into a sort of modern-day Berkshire Hathaway, as he puts it, actually work?
Yeah, it involves 5 key players we need to keep track of. Ackman himself, his firm Pershing Square Capital Management,
Legend Warren Buffett, his company Berkshire Hathaway.
and the company at the center of Ackman's current plan, Howard Hughes Holdings.
Okay, so let's get into Ackman's vision first. What's the actual plan?
Well, the article lays it out. He's already a big shareholder in HHH, about 37%, I think.
Yeah, around that.
And he wants to up that stake significantly to maybe 48%, and not just own more, but actually become the CEO.
Right. And the really big claim, the headline grabber, is his stated goal: turn HHH into a holding company structured like Berkshire Hathaway.
He actually used the phrase modern-day Berkshire Hathaway. I mean, that's
Yeah.
setting the bar incredibly high.
It absolutely is. And to really get what that means, you have to understand the Buffett blueprint with Berkshire.
Okay, lay that out for us.
The FinShots piece uses a great example. Fruit of the Loom. Remember them? They went bankrupt back in '99.
Vaguely, yeah. Undershirts and stuff.
Exactly. So Buffett watched, waited. Then in 2002, Berkshire swooped in and bought it for basically pennies on the dollar, like a 97% discount.
Wow. 97%.
Yep. And then they did the whole Buffett turnaround thing, rescued it, built it back up. The core idea the article highlights is find these really undervalued businesses, often struggling ones, fix them up, and then hold them under the Berkshire umbrella, letting them generate value over the long haul.
Okay, so that's the model Ackman says he wants to follow. But the article immediately points out that Ackman's style, historically at least, seems quite different.
Right. He's usually labeled an activist investor.
Which means?
Well, typically an activist buys a chunk of a company and then pushes hard for changes, maybe new management, selling off parts, whatever, to try and boost the stock price quickly. Unlock value, as they say.
That sounds, yeah, pretty different from the usual image of Buffett, who buys good companies at fair prices and then mostly lets them run themselves, right?
Yeah.
Patient, long-term.
That's the standard narrative. But here's where it gets interesting. The article digs up a bit of Buffett history that's maybe less well known.
Oh, do tell.
It goes back to how Buffett actually got control of Berkshire Hathaway in the first place. It wasn't exactly a passive investment.
Really? I thought he just saw value in it.
Well, the story goes he had a deal, like a handshake agreement, to sell his shares back to the CEO at the time, a guy named Seabury Stanton, for $11.50 a share. But then Stanton sent the formal offer, and he'd lowered the price. Just slightly, but still.
Yeah.
He tried to lowball him by 12.5 cents.
Wait, seriously, over 12.5 cents? That seems petty.
Apparently. And Buffett didn't just shrug it off. He got, well, pretty annoyed. Maybe spiteful is the word the history books sometimes use.
Okay. So what did he do?
Instead of selling, he started buying more Berkshire stock.
Yeah.
Aggressively. Got control of the company, and then he fired Stanton.
No way. The famously calm Warren Buffett.
That's the story. And Buffett himself later called buying Berkshire, because of that incident, a massive $200 billion mistake. Mostly because he then spent years trying to fix the original failing textile business.
So he had his own, let's say, assertive phase.
Exactly. And that kind of move, getting control, forcing change, maybe driven by some personal element. It sounds, well, kind of like the activist playbook Ackman is known for, doesn't it?
It really does. The article even brings up Ackman's big public fight over Herbalife.
Ah, yes, the famous short position.
Yeah, he bet heavily against the company, called it a pyramid scheme. It was very loud, very aggressive.
And very expensive for him in the end, right? The stock went against him, and he lost. Wasn't it close to $1 billion?
Something like that, yeah. Definitely not the quiet buy and hold approach.
So you see these parallels. Both had these, let's call them more aggressive periods. But then, just like Buffett eventually shifted Berkshire towards insurance and diverse holdings.
Ackman has also changed his tune.
Well, he says he has. The article mentions that back in 2022, Ackman publicly stated he was moving away from that kind of activist short selling.
Right, I remember that. He said he wanted to focus more on long-term constructive investments, more Buffett-like.
Exactly. So he's claiming an evolution in his style, mirroring perhaps Buffett's own journey.
Okay, so there's a basis for the comparison, maybe even in their histories, but the
Like,
article isn't buying the HHH plan wholesale, is it? It raises some doubts.
not at all. It lays out three main reasons why Ackman turning HHH into the next Berkshire might be, a bit of a stretch.
What was the first one?
The first point is about HHH itself, Howard Hughes Holdings. While its stock isn't at its all-time high, it's not exactly a lost cause in the way the original Berkshire textile mill was.
So it's not a broken company needing a complete savior.
Pretty much. It's fundamentally a real estate development company.
Hmm.
And apparently even some of Ackman's own investors at Pershing Square didn't think his initial offer to buy the rest of the company was high enough.
Oh, interesting. What was the offer?
He initially offered $85 a share, but the article says some investors thought it was worth more like $120. He did bump his offer up later to $90, but the article kind of frames that as a desperate chase, not necessarily a deep value play like Buffett finding Fruit of the Loom in the bargain bin.
And HHH has actual valuable assets, right? Not just a struggling operation.
Yeah, that's key. They own a lot of undeveloped land with significant potential. There's even a partnership mentioned with Sony to build a movie studio on some of that land.
Okay, so it has intrinsic future value already baked in, arguably. Not quite the same as buying a distressed asset for next to nothing. Makes sense. What's the second point of skepticism?
The second one revolves around how Ackman is trying to buy the rest of HHH. He's offering cash to the existing shareholders.
Right. Cash buyout, so.
Well, the article asks a pretty pointed question. If Ackman really believes he can turn HHH into this amazing long-term Berkshire-style success story, why isn't he offering HHH shareholders stock in the new combined entity?
Ah, so they could share in the upside he's promising.
Exactly. Offering equity would signal, hey, I believe in this future, come along for the ride. Offering cash lets them just leave.
Yeah, that does raise a bit of a question about conviction, doesn't it? If you think it's going to be huge, you'd want partners, maybe. Or at least give them the option.
It makes you wonder if the goal is more about just getting total control rather than building that shared long-term ownership structure that Berkshire kind of embodies.
Okay. And the third reason for doubt?
This one's about fees. Pershing Square, Ackman's firm, plans to charge HHH a management fee, about 1.5%.
A fee from the company he's taking over to manage its funds.
That's the plan, yeah, to supposedly manage its funds better. Now, the article does acknowledge a counterargument.
But yeah.
You could say, well, didn't Buffett essentially manage Berkshire's capital? He took the cash flow from the declining textile business and reinvested it brilliantly into insurance and other things.
Okay, yeah, that's true. He allocated capital.
But, and this is the crucial difference, the article stresses Berkshire was a dying textile company. Putting more money into making textiles wasn't the answer. It needed diversification.
Right.
HHH, on the other hand, is a real estate company. Real estate development, especially with valuable land, usually needs more capital to grow, to build things out, to realize that potential we talked about.
So taking money out as a management fee seems kind of counterintuitive for a growth-oriented real estate firm.
Exactly. It seems fundamentally different from Buffett taking cash from a dying business and putting it somewhere better. Here, it looks more like extracting value from a potentially growing business. It doesn't quite fit the Berkshire model Ackman claims to be chasing.
Okay, let's recap that. So Ackman wants to be Buffett, wants to make HHH the next Berkshire. He's got the ambition, the controlling stake goal, the CEO plan.
And he says he shifted to a long-term style.
But the hurdles, according to the Finschutz piece, are significant. 1, HHH isn't really a distressed asset needing a classic Buffett turnaround.
2, offering cash instead of equity raises questions about his long-term conviction in this specific plan for shared value.
And 3, charging a management fee seems to run counter to the capital needs of a real estate developer and the spirit of Buffett's reinvestment strategy.
Pretty much. Which leads to the article's kicker, essentially. Just saying you want to build the next Berkshire Hathaway doesn't automatically make it happen, doesn't make you Warren Buffett.
Right. The ambition is clear, the comparison is made, but the execution and the specific circumstances, they raise some serious questions.
It boils down to whether the model can actually be replicated under these different conditions and with this specific approach.
So that brings our deep dive pretty much to a close. We've looked at Bill Ackman's big goal, compared his path and Buffett's surprising early path, and explored these key reasons for skepticism about the HHH transformation plan, all drawn from that Finschutz article.
And maybe something for you, the listener, to think about now. Considering everything Ackman's plan, HHH's situation, the history, what do you see as the single biggest challenge for Ackman here?
Is it the nature of HH itself? Is it the financial mechanics of the deal, like the cash offer or the fees? Or maybe something else entirely?
And perhaps, does that glimpse of a younger, more aggressive Buffett actually offer any clues for Ackman's potential success? Or are we looking at fundamentally different situations and times? Something to chew on.